Well, despite today's comeback, one longtime market bull is not sounding the all clear. Julian Emanuel is BTIG's chief equity and derivatives strategy. Julian, always great to see you. So what do you make of all this in the past couple of days? What happened?
Well, the first thing we'll say is if the last 3 days haven't proven, whether you're a stock investor or a bond investor, the utility of options, particularly when the VIX last week was trading in the teens, there's never going to be a time that proves it. Whether you're thinking about protecting the downside or trying to control your emotions in some of these stocks that have run a long way and look like they could run further to prevent FOMO. From our point of view, the market is responding to the climb down in yields with a delay, the same way it did probably before the pandemic, I think is the right way. But clearly, the science has moved much further. The threat is not there to anywhere the degree that it was this time last February or so, let's say. And the expectation is that we are going to have yields turn back higher. The economy is going to reopen, obviously not with perhaps the vigor that was expected several weeks ago, but it's going to happen nonetheless. And so to us, what we're looking for is stabilization in the cyclical plays. Today's action in that respect was good, but we also think, like you've talked about a little bit a few moments ago, that you may have some trouble if yields turn around in terms of the reaction from technology stocks, which have really carried the load for the last several months.
So yesterday was a blip.
No, yesterday was basically something that we should expect again, both to the upside and the downside. The market is just much less certain. And if you think about it, we're not going to have a good idea about what exactly the Delta variant means until schools start reopening. We're going to have that start to happen in the next several weeks, but it isn't going to happen really till in earnest till after Labor Day, when in theory the labor force comes back and normalizes that situation. So there's this uncertainty overhang that to us says you're going to have this kind of trading for quite some time, and negative news of whatever we might get is likely to set the market back within that context.
It's interesting, Julian, because it sounds like there are a lot of unknowns in your view, and rightfully so. There's so much about this disease that we're learning as we go, basically, and the effectiveness of vaccines with this new variant. And saying that, you know, not till after Labor Day, not till schools reopen, et cetera, and yet you're overall bullish still to the end of the year. You want to go back into cyclicals. How do you reconcile that? Because to me, that the risk-reward sounds pretty balanced, unless you really believe that the variant is not ultimately going to be an issue. And so that's again, science. That's hard to handicap.
That's right. That's right. So from our point of view, the near term looks problematic, okay? And when I say problematic, we're expecting a test of 4,000 between now and the end of the third quarter. But there's no denying that we have put into motion the seeds of a very long-lasting, vigorous economic recovery. And we measure that by the ISMs. When you've seen ISMs over 60, as we've had, that really started the year, the long-term message is that the bull market is going to top 2 years out in front of us, and that you're not likely to have a recession for almost 3 years. And when we think about it, we could see over the next 24 months a further advance on the order of 30 to 50%.
Wow. Julian, thank you so much. Good to see you.
Thank you.
Julian Emanuel, BTIG. Tim Seymour, you agree with Julian? Still go all in, and not all in, still go into oil trades, into material trades?
Well, I do think that we're at a place where the economic strength is very much belies what the stocks have done over the last 6 to 8 weeks. We've talked a lot about that. The stocks even led the commodities. My view is we're way overthinking this one. Okay, until the Fed starts tapering, you're buying equities. and there's absolutely no sign that the Fed is going to change gears anytime soon. Delta variance gives them ground cover. So I understand we're looking at the global growth dynamic. I understand that we're actually looking at the decline in yields as maybe, you know, being the harbinger of something more sinister. But again, I tend not to get overly righteous on the market breadth or lack thereof. If we're talking about investors, there's a lot of liquidity sloshing around. There's a retail investor that's been, I think that basically the mentality is you're buying every dip, and until something happens, that's what they're going to do. So it's all about liquidity. I do think earnings are going to be extremely strong in the second quarter, and based upon the strength of those that outperformed the first quarter, you're going to see their numbers in the second quarter be even better.
I think that's a really interesting observation, in sort of a perverse silver lining to an uptick in cases overall in COVID in its variant guide, that it gives the Fed cover not to do anything, to keep things as status quo, which would be good for the markets, except to Dan's point, we have come a long way since the start of the pandemic in terms of where the markets are. So how do you put those two things together?
No, I think Tim makes a great point. I mean, obviously the move down in yields has given the Fed, you know, it's given them a lot of air cover for a lot of different things. I will say this, and let's sort of shine a different light on this thing. You know, the United States is still the biggest economy on the planet, last I looked. I would submit, maybe correctly, incorrectly, that 10-year yields, which should be the most liquid asset or instrument on the planet, should not, in my opinion, move 5, 6, 8 basis points a day, actually within hours. It's mind-boggling to me, the volatility we're seeing in the 10-year yields. Now, that was the precursor to equity volatility back, if you remember, January, February of 2020. We'll see if that's the case now. But bond volatility, to me, is too severe, and I think it's going to manifest itself in equity volatility at some point.
Shepard Smith here. Thanks for watching CNBC on YouTube.